Good morning, everybody. This is Dennis Wilborn from Active Trend Trading. I want to welcome everybody to this bonus training that we're going to be doing here shortly. Today's topic is basically the 7 reasons why we make bad trades, or the reality of where we buy. I want to remind everybody that all materials that are presented today are for training purposes only, and traders should always paper trade any new method prior to the risk of your own personal capital. So I got to thinking about this, and you know, one of the main questions that people email to me about a particular stock or a particular entity is always, and the question tends to be, is it too late to get in? And oftentimes that's due to a signal happened several days ago that was a good buy alert that triggered an action point to enter the trade. So if you've been trading for a while, you know where optimum buy points are. We'll take a look at a couple of charts here shortly, but yet in reality we often do not buy at the optimum points. There's the old adage that poor entries lead to poor exits. And if you have been trading for a while, I'm sure that you can relate to that, that statement and that quote. In order to become a wise, disciplined, patient, and profitable trader, waiting for optimum entry points is critical. Now, in reality, do we ever really get an absolute optimum entry point? Yes, occasionally. But what we're trying to do on our entry points is to basically hone it down to where we're getting as close to optimum as possible. So why do we insist on entering trades at less than optimal points? I list a couple of things here: fear of missing out, being too early, being too late, being wrong in our analysis, lazy, impatient. We're at the hard right edge of the chart. And there's many other reasons why. We're going to cover the 7 of those reasons today. So what can we do to modify our trading behavior so that we can achieve more optimal entry points? Well, let's take a look. Here we are at the hard right edge of the chart. Let me get my drawing tools up. We're at the hard right edge of the chart. What now? Is it time to go long? Is it time to go short? Is it time to, what is the chart telling us? The indicators look promising. Okay, we got stochastics down here looking like they're getting ready to turn up. TSI looks like it's a little bit still weak, but it looks promising. It's higher. It's basically got some nice positive divergence going here. We've just had a hammer about a week and a half ago, and it looks like we're now pulling back to retest that hammer. The volume profile looks okay, not great, but what do you do? What are we waiting for? And so part of the deal is we want to identify the convergence of clues to say, okay, if this price action goes here, this is what we're going to do. Maybe one of the things that comes to mind is the old adage of maybe it won't work this time. Even though I've been following this system for quite some time, it's been successful. It's hitting its percent win ratio and all of that, but maybe it's not going to work this time. A lot of times how we sense and what we think about a trade is a direct relation to what happened in the trade just before this. Let's say that you got into this trade here, and you said, oh, this is awesome, but you held on to it, you got stopped out right here. Well, would you want to jump right back into this trade even though it looks like it's building some strength? Recency bias can have a big influence on whether or not we will trust our system and move when it is time to move. So as we see, here's what happened. We had this signal here, and then it proceeded to go on and move up, and actually led to a very nice trade. Went from almost 100, this is in Netflix, earlier this in 2004, bounced up. We bought off the 8-day moving average. We would have bought down here at about 330-ish. and then we rode on up. So sure, sure enough, it turned out to be a great opportunity, but was I left sitting in the gate? In other words, I couldn't make a decision here. I got up here and asked the question, is it too late? Even though we didn't get a secondary entry point here bouncing off the 8-day moving average. That was an okay place to enter. Or maybe we got in at the high of this day and it went against us and we bailed out because at the high of this day would have been a poor entry point. However, bouncing off the 8 days moving average would have been a good entry point. So what now? We got a little bit of a shooting star. Did we go short? Do the clues tell us what to do at this point? I'd probably say at this point, no. The only clue that it's talking to us at this point is basically it's not time to go long yet. We have to wait for another entry. So that was that shooting star right there, and as you can see, the price action continued to push up for another $50 from $425 up to $475. But when we get and we look here, we go, well, what now? Are we getting, is it time? Is this going to be a bull flag and it's going to bounce and go higher? Or is this the rollover? Or do we have any clues whatsoever that are telling us what to do on this particular trade? So clearly, when we're looking down here, let's take a look real quick. If this chart, if this stock came onto our radar here, and we say missed the first move when it moved above that level or moved above the 20-day level, we have another position, or we have another opportunity here to get in, bouncing off the 20. What about over here? Let's draw some lines in here. There we go. Nice little flag down, a nice little break of the high entry point there. Then, of course, there is this entry point here off a little bit of a flag. So that's 1, 2, 3. Nothing, 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 nothing. One could make a case to make an entry basically breaking out of that resistance area. But clearly, when you get a pullback here to the 8-day, that was the next and only potential entry that showed up along this line after you got past this area here. But would we have been ready for that? Or would we have seen that and all of a sudden been, oh, I'm afraid it's going to drop more? And so part of the thing is having a plan. We'll get into that here shortly. So let's go through some of the reasons why. Regardless of what our trading trigger is, there are times for action and there are times for waiting. 7 reasons why we don't wait. We tend to either be too early or too late. One of the reasons why that affects where we buy is we have a fear of missing out. As I said earlier, one of the questions I get to answer quite often, is it too late to get in now? And oftentimes the answer to that is, well, yes, you need to wait for a little bit better setup. Second reason is I do not have a clear alternative entry strategy. As you think about that Netflix chart, there was the initial entry action point, but then there were several additional alternative entries that could have been made once it started going in a positive direction. 3, no clearly defined rule or rules. 4, we accept close enough mentality. In other words, we get into a habit of saying, well, yeah, I missed the precise trigger. I didn't have my conditional order in. I hadn't done my homework. This is close enough because I don't want to miss out. And what's very interesting is several of these are actually related back to number 1 here. So we accept close enough. This can lead to accepting a close enough mentality or developing one can lead to impulsive trading. And impulsive trading, those who have been trading for a while know that that is a very dangerous place to be if you're trying to conserve and grow your capital. We're trading at the hard right edge. Oftentimes when we are looking at proper entry action points, it's a scary point on the chart. We've either just done a significant pullback, and the stock is maybe starting to bounce, hopefully starting to bounce, and we're sitting there going, well, what happens if it's not going to work this time? We track too many stocks, number 6. And then sometimes we can get stuck in a cycle of continuously searching because we need to feed the craving to trade. I have to have something to trade. If I don't have something to trade, I can't make any money. If I can't make any money, I can't pay the bills. And so it can get into a huge cycle that's primarily fear-driven, but it could also be impulse, because maybe looking for that thrill of thrill of the deal. So here's some points that I like to make. How do you combat these reasons why? The fear of missing out. First, gain an understanding of the cycle of the individual stock. Oftentimes we will see, let me pop up a real quick chart here. What do I have? Tesla. And as you're all aware, Tesla is one of the stocks I've really enjoyed trading throughout this year. And so get an idea of the cycle, and you can take a look at either the stochastics and or the TSI. When is it hitting its low points? Because we all would love to be able to say, well, I got, here's a low point, here's a low point. We know where we should be looking to get in. However, we tend to see these too late, and we wind up looking up here when it's just about ready to turn around. And then we are unwilling to wait for that additional time. So you can go back in time and get a rough estimate of how long does it take, what's the time period between these peaks. So between this peak to this peak, so you can see there it was 12 trading days or 15 calendar days to this peak. It was about 20 days. So it looks as if Tesla goes on a cycle of somewhere between 15 and 20 days. And so if we go over here, we can sit there, pop this in, stretch it across the line. There's a 15 to 20-day cycle right there. And sure enough, it started to pop back up. But you can literally track the cycles. Is it exact? No, you have to combine that with the convergence of other clues. But as you can see here, where it started to rebound and start back up, I got to do down here. There we go. Okay, that was about 13 days. So we had said 15 to 20 days, and it hit about 13 days and started to rebound. But then what about to the next one where it gives us a little bit better of a rebound? We're talking about 22 bars, or about 30 days, and this one here is right at about 22 days. So get an idea of what the cycle time is. Secondly, gain a better understanding of what you fear. What are you truly afraid of? That can be anything from, I don't want to lose any money, I don't want to have any losing trades, to I only have a little bit of capital, and so I have to be really, really, really careful and with how I trade, so it's much easier just to not take a trade. Number 2, I do not have a clear and alternative entry strategy and no clearly defined rules. These two reasons basically go together, and often we often do not follow rules or strategies because we don't think we need no stinking rules. And the fact of the matter is with the active trend trading system, it has rules, and the rules are they're an insurance policy to, one, keep us out of trouble in case a trade goes against us, but then also to keep us in trades long enough to take profits where appropriate. The rules are our friends. Number 4, we accept a close enough mentality. my suggestion here is just say no to these ideas and gain an understanding of what leads you to have this type of mentality. I know for myself, having been a former naval aviator and flying jets and going off carriers and all that type of stuff, I know that often, while we did fly for precision, we also recognize that we had to, perfection was never absolutely obtainable. And so we would occasionally tend to fly by the seat of our pants and just made it in, just got back on the deck of the ship, just this, just that. And so just be careful and try to get an understanding where, if you're a risky kind of person who likes to take risk, you can wind up telling yourself stories that are lies. They're saying, well, if I'm close enough, it's going to turn out okay. Because I go back to the original thing I said at the beginning, poor entries lead to poor exits. And that saying has worked out so many times in my own trading. We're at the hard right edge. One of the ways to deal with being at the hard right edge and dealing with the issues that come up with that is gain confidence in the system, accept the fact that no system, I mean absolutely no system, is perfect and that there will be losing trades along with winning trades. Active trend trading, we hit about 60% winning trades to 40% losing trades, but we managed to keep our losses extremely low, and our winners, and the winners grow nicely. Do all the winners grow nicely? No, but by controlling the losses and keeping them extremely low, the winners that do turn out to be really, really good winners, they propel the majority of the portfolio. Too many stocks, cut down the number, and the answer to that is basically cut down the number of stocks you track to those with the best pattern and discipline yourself to wait. This particular one, too many stocks, can be connected back up here to number one, which is the fear of missing out. It reminds me of I was once coaching a lady who was a psychologist, and she basically, when I was trying to cut her watch list down and the number of things she wanted to trade from like over 100 down to, maybe 20 to keep an eye on all the time, she goes, I can't do that. I can't do that because I may miss something that moves. And I shared with her the story about the guy who only traded Apple. That's all he traded and did exceptionally well because he disciplined himself to wait for the proper setups on Apple. But she was having none of it. She basically said, no, I would rather chase all the different stocks because that way I won't miss out. Even though, in reality, she was missing out because while she was looking at stock A, over here, stock C was taking off, but she couldn't focus in both places at the same time. And then let's see what is the listener stuck in a cycle of continuously searching. We need to feed the craving to trade. And on this one, it basically looks like my slide may have been cut off just a little bit. Having the impulse to trade is about meeting other types of needs that you may have in your life. And if that's the case, then you're going to have to dig a little bit deeper into that aspect of, okay, why do I have this compulsion that I have to have money involved in the market all the time? Remember, cash is a position. If you just want to be clicking that button to buy and sell, try to use paper trading as a pacifier. It can work for you very well. So let's see. So the reality of where we buy, all traders are challenged by the reality of where they buy and where they sell. Journal. If you don't journal now, just start. Journal your entry. At least this is a minimum. Journal your entries, journal your exits, and be honest about where you're getting in and where you're getting out. What you were seeing. Write down what you were seeing on the chart. Write down if it was basically an impulsive, it was one of those where I should have probably waited, or I was too early, I was too late. And so it will help you identify tendencies which can then be either strengthened or corrected. Some of the tendencies we have are really awesome. Focusing on one particular pattern, let's say a flag pattern or a break of a downtrending or an uptrending trend line. Let's say that's the trigger you're going to focus on. That's all you're going to focus on. If I don't get that signal, that pattern, I'm not trading. That's excellent, and it's also an excellent way to develop the discipline that each of us need in the trading environment. I found that it's usually when I enter, I find that if usually when I enter well, I exit well. They are connected, folks. They really are. So typically, good entry or proper entry leads to a proper exit. So I hope you found this helpful and something to think about as you're getting ready to move from this year to next year. And may we all continue to become wise, disciplined, patient, and profitable traders. So with that, I want to say have a great holiday weekend, or holiday week, couple of weeks. Merry Christmas, Happy New Year, and we'll see you next year. I want to remind everybody that we only, those who are not members of the Active Trend Trading or the early warning system, that we do have 7 days left to the end of the year for a membership special. You can find details on that in 2 different locations. One is right here on the Active Trend Trading website. Just click here on membership subscription and it'll take you to the special that we're offering currently. And the other one, you can go to my YouTube channel, which is Market Tech Talk. And right here where it says December membership special, you can click there and it'll take you to a page that defines what our specials are. So again, thank you all for joining us today, and I hope you enjoy this bonus